Look at the 9 months compared to last year, okay? Gross profits at 21.7 with a 13.4% margin versus 17.3 versus a 15.9 margin, okay? Failing grade, guys. It is your boy Colton, and this is the Financially Fit channel. If you are new here, you may want to consider subscribing. Smash that thumbs up. We are currently at Starbucks because I care about my subscribers. Guys, what I'm going to do today is I'm going to just briefly go over Tattooed Chef's earnings. I'm going to give it a score. If you are on my live stream, you're probably going to hear a lot of the same information that we went over live. But what I want to do today is kind of just break down some concerns, some things that I'm looking at that maybe are not being brought to people's attention, okay? So I want to do that. As always, guys, this is not a channel where we pump stocks. We don't, we just give it to you as it is. We interpret the information and we give it to you, and you guys do what you may with it. I've caught a lot of hate actually for giving my opinion, even though it's been really accurate, but that's besides the point. So anyway, I just want to thank everybody who's been, actively on the channel, leaving comments, leaving thumbs up, and just, I appreciate the constructive criticism as well. I'm trying to do the best as I am on the road in Las Vegas. So, Starbucks is the place, and man, I wish I would have invested in them because I spent a lot of money at Starbucks. Okay. Let's get back to it. Some other things we talked about was, are there other companies that are better opportunities than Tattooed Chef at this point? And I wouldn't say better, but I would say safer opportunities. And so we'll go over that at the end. I'll give you guys two stocks that I really like that are growing revenue at the same clip as Tattooed Chef, but personally I think are a little bit of a safer play with inflation and just some of the things that are taking place in the market. But let's get into it. There's no denying that the two things that absolutely stick out is obviously going to be at the top of their list. And what is that? That is revenue growth, and that is branded revenue, okay? Both increased by a significant amount, right? So revenue growth was at 44% year over year, which is just awesome to see. If you're an investor, that is absolutely the type of growth you want to see with your company. Personally, I actually thought I honestly was not expecting such good revenue growth from them this quarter, as I thought logistics were going to be a bigger problem, and I thought we were going to see 35% roughly revenue growth, but 44 is absolutely awesome. I'm not going to take anything away from the company on that, guys. Nothing wrong with that. You should be absolutely proud being a shareholder and getting 44% year over year revenue growth in a very competitive market, okay? Secondly, branded revenue growth. That is awesome to see as well. Why is that? Because that's going to grow their margins longer term, in my opinion. Okay, there's a lot less variables involved with the branded revenue growth, and that clipping up 56% is another number that there's just no denying those two numbers. I'm not going to take anything away from Tattooed Chef. Those are by themselves B plus A minus type of numbers. Okay, so right off the bat, they have an A. We'll give them an A minus right now. Okay. So let's scroll down and kind of just go through a little bit more of some of the concerns that I have. All right, let's start out with gross profit, okay? Gross profit was $5.9 million, okay? Or 10.1% gross profit margins. Why is that bothersome? Last year, they had gross margin of $4.2 million and 10.3% margins, okay? Guys, what's one thing Tattooed Chef has been selling us on? It has been the vertical integration, and margin growth is supposed to be growing quarter over quarter over quarter, right? But as we can see in a full year guidance, margins actually came down, okay? Now, it didn't come down a lot, but it's coming down enough to where you have to be concerned. The margins are already slim, and the fact that they're coming down makes me nervous, okay? That, I would say, is, that's a failing grade, okay? When you're doing 50%, almost 50% more in revenue, but your revenue only grew about $1.7 million, okay, and your margins came down, those are numbers that are not impressive. That is not something I want to see. So overall, I have to give it a failing grade on that, guys, okay? Now, if we would have saw a 10.5% margin growth and we would have saw, you know, revenue of 6 or 7 million versus 5.9, I can get behind that. I can give that a B, okay? But this, in my opinion, is about an F. So them moving up a slight amount is definitely would have given them a passing grade overall, guys. Okay. So overall, I think that is you know, that is a problem. Okay, let's move down a little bit more. Here's another red flag, guys. Gross profit was at 13.4% versus 15.9% year over year. So it actually came down roughly 2.5%. Okay, that is a lot, guys. Okay, gross profit at 21.7 million versus 17.3 million. Okay, so when we look at the 9 months compared to last year, okay, gross profits at 21.7 with a 13.4% margin versus 17.3 versus a 15.9 margin. Okay, failing grade, guys. That's 2.5% down. All right, that is alarming. Okay, that is alarming. That is 20% down year over year for margins when we already know the margins are squeezed, right? So 20% down is not good. In my opinion, that is going, if this doesn't change, they are going to be burning a lot more cash, and that means more shares are going to have to be dumped on the market. Okay, just my opinion. One more thing we want to talk about is going to be the adjusted EBITDA, okay? That's earnings before interest, taxes, depreciation, and amortization, okay? That was at $14.7 million compared to a negative $14.7 million compared to a positive $10.2 million. Why do we look at EBITDA? Well, when we look at EBITDA, we're looking to see, like, how close is the company at free cash flowing, right? EBITDA is supposed to be like a metric, that a geeky number metric where we can start seeing, okay, is the company getting closer to positive cash flowing? Is the company getting closer to free cash flowing, right? And actually, when we look at these numbers, it's getting further away from free cash flowing. Now, I know that they've had a lot of acquisitions and they're spending a lot of money on being innovative. But this is a red flag, guys. If you are ignoring this stuff, you can't be surprised that the stock's going down, okay? So that's something I want to bring to your attention, okay? You can't be surprised that the price is going to go down when you're getting numbers like this, all right? Another thing I want to talk about that I am happy with on Tattooed Chef is it didn't look like they diluted any more shares on the market, although I do find the last 3 or 4 trading days extremely interesting, and I wonder if they filed their quarterly report and maybe put some shares on the market afterwards. I'm not accusing them of that. I wouldn't be surprised, guys. That's all I'm trying to say with the action that has been going on with the stock, okay? The next thing I want to talk about is the current liabilities and current assets, okay? Current assets has only grown about 2 million year over year, from 266 to 268, okay? So not much growth on the assets, guys. And the liabilities has went from 30 million to 38 million, okay? So liabilities are growing, current assets are not growing. Now, I do think current assets are going to kick up massively once they get into the tortillas and plant-based snacks. That is what I'm waiting for, guys. That's where I think this business model completely flips around, okay? That's just my opinion. Maybe I'm wrong. I'm too concerned with the slimmer margins, the EBITDA going in the wrong direction. So, net income loss. Let's talk about that really quick. And this is where I'm getting a little confused, and maybe if anybody is watching this, drop a line in the comments. I don't claim to know everything, but let me get to this really quick. Net income loss year over year. They were positive 3 million, call it 3.5. They were positive 3.5 million last year. This year they're negative 70 million, okay? When they're losing 70 million, how is their cash position not affected more drastically, right? Am I missing something here? How are they not affected more drastically on the losses with the cash position? Negative EBITDA for year over year is negative 23 million versus negative 6.5 million. So just something to think about, guys. I don't know, am I missing something, but negative 70 million negative 70 million income versus positive 3.5 million from last year. And their cash is only down about $2 million. Now, I do know that they did put 10 million shares on the market last year, around $20 to $25 a share, which would be, you know, pretty substantial amount of money that would be able to handle these losses, but I'm not seeing that anywhere on the balance sheet. So overall, I give it about a C+. If you were on the live stream, you probably saw that. So C+ is about what I give this. You know, I think that when you average out the growth, revenue growth, and the branded revenue growth versus, you know, some of the metrics on the bottom that really are what we're waiting to happen to actually make the stock appreciate, if you will. When you factor those two things in, I give it about a C. When you factor those two things in, I give it about a C+. So when we think about companies that I feel that could give you more value, or, you know, just as much opportunity as possibly Tattooed Chef without the risk, you know, Corsair Gaming is definitely one of them. So, you know, and I've talked about this one before, and the reason why I say that is because they're actually free cash flowing right now at $47 million free cash flow. They're growing revenue at 35 to 40%, which is pretty competitive to what Tattooed Chef is doing. They have cash on their balance sheet. They're doing 1.9 million in revenue, guys, and their market cap sitting at 2.4, okay? And they're growing revenue at 35%. So that to me is a no-brainer. I think you can get great compounding interest in owning a stock like that. It's definitely beaten up. If you can get in around $23 a share to $24 a share, maybe even 25, I wouldn't mind paying. I think you have a pretty good deal in Corsair Gaming, and I think you're going to have some good growth going forward. They're very innovative. They're being just as creative as Tattooed Chef. One of the concerns I have with Tattooed Chef is with all the brands, with all the new products that they're putting out there, what's the cost of all those products versus what they're really selling, right? The cost to do 100 products versus 20 is much higher, but are those 100 products as successful as maybe your top 20 products? Probably not. So there's a lot of eaten cost when you start putting more and more products out on the shelves. So that's just a concern of mine as well. I would much rather have 5 or 6 products and all of them be home run hitters and net me a gain every year, rather than have 100 products on shelves and 5 or 6 be net winners, okay? Stock I want to talk about that I think is equally as good, has equally as much upside to Tattooed Chef, but definitely more risk than Corsair Gaming, is going to be Hims, okay? Growing revenue at 73%, which is just unreal, and then you have 228 million in revenue, which is actually more than Tattooed Chef. So they're growing revenue more. They have more, they're growing revenue at a higher clip, and they have just about as much revenue as today as Tattooed Chef has. And the market cap is sitting right around the same value. So you're actually, if you're comparing apples to apples, I think you're getting better value with Hims right now because of how much they're growing revenue, okay? So, you know, just, that's my opinion, guys. I would rather buy Hims, most likely, I would rather buy Hims today than Tattooed Chef, just because of how much they're growing revenue. But with Tattooed Chef getting into plant-based bars, plant-based snacks, and all those other avenues, the fact that they're going to be on every shelf and every aisle, you know, absolutely brings a tremendous amount of value. The question is, can they execute, right? So that is the question, and that's all ifs, right? What we know today is that Hims is executing at 73% revenue growth, while Tattooed Chef is, you know, at 40% revenue growth, and they're running around the same market cap. So the risk reward for Hims and Tattooed Chef is fairly similar, but I'm leaning more towards Hims just because of that revenue growth, guys. As always, I hope you appreciate the time and effort I put into this. Thank you guys so much for being active, and appreciate and I just appreciate you guys so much. As always, feel free to subscribe, like, and we will see you next time, investors. Peace.